Welcome, everybody, to another episode of What's on Your Mind. I'm Chris Quill, and I'm joined today by Anthony Iser and Raj Malhotra. And guys, it's fantastic to have you on the episode. Thanks for coming on. There's a lot sort of happening in markets and in the world generally at the moment, lots of volatility to go around. So I'm sure you guys have some interesting stuff to say. And with that, Anthony, I think we'll start with you. What's kind of been on your mind over the last couple of weeks?
Thanks, Chris. Hi, Raj. Hello, everyone. Obviously, huge, geopolitical events abound at the moment, but I'm focusing on ideas and stocks rather than what Putin might be trying to do. So I've been looking at Planet Fitness for a whole bunch of reasons that I'll get into. So Planet Fitness. Currently trading at 78.41 pre-market on Wednesday. It reports in about 3 months' time, Wednesday, May the 5th, $7 billion market cap. The sector looks quite good. Tourism and leisure, entertainment starting to come out of the winter blues, starting to come out of post-COVID Omicron peak in January. So I was looking at the sector, compared this name to a whole bunch of stocks in the sector. And this was the one that I felt most comfortable with. Some of the stocks in the sector are high-tech gaming companies with negative earnings like DraftKings, or they're loaded with debt like Live Nation, or something like SeaWorld, which is low growth. These guys, on the other hand, plenty of growth, trading at a premium, and have fallen back from sort of 95, 96 down to that 78.41. So who are they? If you're not in the US or one of the other countries that they're in, you may not know, but as the name suggests, they're a big box retail gym. Lots of these are sort of 20,000 square feet in size. They've got three main divisions to their business. So they've got their corporate-owned gyms, 25% of their revenue, 20% of their EBITDA comes from gyms that they own and operate. Second division is their franchise gyms. This is one of the biggest franchise operations in the US. 40% of their revenue comes from franchisees and 60% of the EBITDA, so pretty big margins in that division. And then the third division is equipment sales, which they sell to those franchisees. 35% of revenue, 20% of EBITDA. And so, pretty simple business, really. Building, owning, operating, and franchising gyms. Trading on 52 times PE, no issues on debt or solvency, which I'm starting to look at a little bit again for some of these companies as rates are going up, stock prices are coming down. Tend not to look at it too much. But always just a quick check. So net debt to EBITDA is 5.5 times. That's fine. EBITDA to interest 3.2 times. So that's also fine. Now, the thing that stands out for me for this stock in the sector is the growth and the forecast growth, and just sort of how secure that seems to be, barring another round of COVID and anything else that we can't predict. But it looks pretty well sort of locked in for a whole bunch of reasons, which I'll get into. So sales growth for next year, 55%, the year after, 18%. And that number, or the number for the sort of next 12 months sales, has been growing sort of pretty steadily since October last year. It's grown from 650 mil to 900 mil, while the share price did rally up to that 95 mark and has come back. So big gain on the sales growth, but the share price not coming back. Lots of this multiple contraction that we're seeing, and it's bringing out some opportunities in names like this. When we get to the earnings growth, even stronger. So good operational leverage in this business that I'm finding attractive. So 84% earnings growth in 2022, followed by 38% forecast for 2023. So 5 main reasons why I like this company. Firstly, as I said, it's a franchise model, and their franchise model is great. It is provides very strong economics for the franchisees. So much so, there's a waiting list private equity are often franchisees. Other people are lining up for stores. I'll spare you all the detailed economics of the franchisee structure, but needless to say, the average unlevered return on cash for the franchisees is about 25% in the second year when they're fully operational. That's a very good return if you know how to run one of these businesses. And as I said, it's quite selective. They've got 130 franchisees, and many of them have multiple stores. 98%, in fact, have more than one store. So they find good operators and help them grow. That said, they're not too reliant upon any one operator. 35% of them have more than 10 stores. The rest are all under 10. Second reason I like it is there's no supply chain issues. And so for every company I've been looking at for a year or more now, one of the questions you have to ask are, who are their suppliers? Where do their suppliers come from? These guys do not have that issue. They have no supply issues whatsoever. Effectively, they don't really have any product. The only things they do need to buy is gym equipment, and that's got long lead times. That's all fine. They know well in advance, often years in advance, what the likelihood is in terms of needs on that front. Third point that makes this look very attractive to me is the limited labor costs. They only have 10 to 15 staff per store. So every other company I've been looking at has talked about labor shortages, huge pay increases coming through, inability to find staff whatsoever. Every industry is talking about it. These guys are having small issues on that front, but it's not a big factor for them because they've only got 10 to 15 per store, to the point where they're actually expanding margins. Fourth point is that 25% of their customers have closed permanently over the last two years since COVID started. Any industry where things are hyper competitive is always tough. This is no exception. But when your competitors are going out of business, it gives you a lot of leeway and a lot of opportunities for expansion. Which brings me to the fifth point and final point is there's a lot of growth, and some of that is coming from expansion. So let me talk a little bit more about that. Firstly, what happens with sales growth? Where does it come from? There's sort of two initial points. You can either put up prices, which they're doing a little bit, or you can get more sales, more volume. And they're getting a lot more volume. They've added 1.7 million members in the last year to 15.2. And those new members are coming from two different sources. They're coming to existing gyms, so same-store sales growth, 12.3% last year, likely to be something similar again in 2022. The second source of new sales growth is from new stores. They opened 132 last year, forecast to be opening 170 in 2022. So that's almost 10% growth on their current sort of touch over 2,000 stores. So we've got a whole bunch of avenues for growth coming through on that front. And as I mentioned, the other leg of growth is price increases. Now, price increases are no good if your costs are going up so much and you're chasing your tail, trying to just maintain margin. But their margins have actually expanded a little bit. And much of that is people moving to their Black Card, which offers a whole range of additional benefits over the standard gym membership that they have. That's up to 62.5%, increase of 2% last year. I would expect something similar again this year. And as I said, margins expanding 41%. In this environment, that's pretty impressive. And there's not a great deal that can go wrong. We could still see some margin contraction in line with the rest of the market, but all the shorts that I've got and that I'm looking at are working well in this environment. So I've got some leeway on that front. If they come back, there's plenty of shorts that will work. So the real risks is twofold. One is some sort of COVID outbreak again that drives people back inside over the summer. The second thing is January is usually the biggest month. Everyone sort of post-Christmas, New Year's resolutions, often 40% of their signups will happen in January. Because of the Omicron peak in January, that number was down. So we'd expect them to defer and come through in February and March. But if they don't, there's a small sort of crimping of that growth number that might happen there. And just with regard to trade structure, I want to capture that reporting date on 4th of May. So I'm looking at a calendar ratio spread. I'm going to sell April $85 calls, buy May. I do it in a 2-for-1 ratio. Be selling for about 450. Selling for 250, buying for 450. So a couple of dollars difference, basically a debit of about $6 in my 2-for-1 ratio. Ideally, we drift sideways and the April leg drops out, leaving me fully exposed. But even if we do see a rally, then we've still got net long exposure, which I'm going to feel pretty good about. So that's it, Chris. In this sort of market, an idea like this makes me feel pretty good about things. It's not the most spectacular product, and if you're in the US, you've probably seen one in sort of every town you go into. But it's providing relentless growth. And prior to COVID, quarter after quarter, it grew revenue, and I expect it to return to that in a big way as we come into the summer in the US.
Awesome. Thanks, Anthony. Good stuff. Raj, let's go over to you. What have you been looking at?
Thanks, Chris. Thanks, Anthony. It's funny, actually. Planet Fitness. One of their the things that they were promoting always was free pizza nights, which was interesting for the U.S. as a. Not sure how that fits into fitness, but that is an interesting marketing tactic.
Get you in that vicious cycle, Raj.
Exactly. So anyway, yeah. So obviously, it's been a very interesting market. And for those of you at home that aren't used to these type of markets, I'm going to give you a little bit of a historical perspective and kind of like where we're at and how to think of the market. So if you look at, remember this is a market of stocks. It's not a stock market. So what's clear has been that there's been some pockets of strength, which has obviously been commodities and commodity-like names, and pretty much a bear market and everything else. So if you sift through the two, the commodity long part of the market, it's been trading in a bull market. And while it's been obviously a good trade here, you have to be careful here that it can reverse quickly. All the gains that have been made in the space can reverse very quickly on a headline. So just be nimble in terms of that. And on the contrary, in terms of the growth / beaten down sectors of the market, those are trading in a bear market. And if you're not used to trading a bear market, what generally happens there is all these sell-offs are somewhat orderly. If you've seen in this market, you're down 2%, down 3%. And again, it can have a quick rally the other way. So the bear market rallies can be nasty. Historically, if you look at 2008 in the financial sector, all the biggest percentage moves in the market in financials that year were all to the upside. Even though, if you look back, some of the financials, including ones like Lehman Brothers, went down 100%. Still, their biggest moves on a daily basis in a percentage were to the upside. So that's something to really keep in mind here as you're looking through this market. The other thing too is when I look below the surface here, you're starting to see some relative strength, which means like if you look at equal weighted indices, they've actually outperformed the broader market. So what that tells me is kind of what Anthony was talking about in terms of Planet Fitness. I believe their market cap's around 7-8 billion. There tends to be relative strength right now if you look at the mid cap to small cap sector. And obviously, a big part of that is because they're not multinationals. Because if you look at the US versus everyone else, versus Europe per se, there's relative strength. And those are the kind of names, if you're looking for what I'm just trying to say here is like kind of sifting through the garbage of names that have really been beaten down. Those are probably the ones that are least exposed to what's going on in the rest of the world. Because like Anthony's, his idea, are you going to join a gym or not join a gym because of what's going on in Ukraine? It really doesn't matter day to day. So really, that's kind of where I've been looking to kind of find longs here. and be nimble. So having said all that with the intro, a name that I've looked that I do like here in terms of growth names, some of the names have really come down a lot, and rightfully so. And some of them have been, in my mind, unfairly punished. So that's kind of where you're looking. If you're looking for some upside a few months out, I think there are some opportunities in that space. And one of them I have my eye on that I initiated a trade on was a company called Digital Turbine. The ticker is APPS. What I do like about it is it's a small mid cap. It's about a $3.5 billion market cap. The stock's about 60% off of its highs. And I do believe the market does turn around. Let's say the Qs rally 10% from here. Names like this could have 30, 40, 50% upside once the market starts looking at fundamentals again. So if you look at the most recent earnings report, which was on February 8th, they reported 50 cents for the quarter versus an expectation of 43 cents. And their revenue was 376 million versus an estimate of 353 million. And the revenue growth was so impressive. When we look at a Q3 year-over-year increase, they increased their revenues 324%. So if you look at this name versus some of the growth names that have been also been really very punished by the market, and in my mind, much more fairly than this one, this company makes money. Like they actually guided for this year, for the full year, to $1.68 earnings per share, which was actually up from $1.60. And again, for a $3.5 billion company to be that profitable, it's actually much better than almost all of its peers, because the company's like I said, they're making money. Their revenues are expected to be this year a little over 1.2 billion. So if you look at that on a sales market cap per sales basis, it's about a 3 times sales to market cap ratio, which is, some of these companies have had 10 to 20 times. They were trading 10 to 20 times during the pandemic. So if you on a long-term average, this is actually not expensive and almost to the cheap side, even though the PE is still 75, which is obviously high. But the company expects to continue to get more profitable and continue to grow revenue. So even if that PE ratio comes down, it's for a growth company like this. When I go into what the company does, it's very the numbers are pretty impressive. If you look at where the company's trading now, the stock's trading below 36 as of the time we're talking about this. It traded $55 just a few weeks ago post earnings, which is down 25, and it's down 25% alone in the last 5 sessions, which again I think is just a lot of times companies get dragged down with the market and sometimes unfairly, and I think this is one of those ones. So let's talk a little bit more what the company does. They basically provide apps. On the last quarter, they've been on over 800 million devices. And if you look at and they've done a few mergers, which I'll talk about. But if you look at their early synergies as a combined entity, they've not only obviously improved revenue, but they've improved their margins. So I'm not going to go into all the calculations, the DCF calculation I did, but I mean, I think their fair value is somewhere in the 90 handle, which is, I don't expect to get there soon, but something to keep in mind. So in terms of their business, they have a few businesses. Their main one is on-device media, or also known as ODM. During the quarter, the company's added 68 million devices. They're on 68 million more devices, and now like I said, they're on over 800 million devices. Now, the majority of the business, about 2/3 to 70% of it, is on Samsung versus iOS. And what's good about that is, if you look at Facebook, why they got it down was because the privacy issues on the iOS, where people are opting out of the ads. Samsung doesn't have that problem as of right now. And their partner, Google, who's a big partner of theirs, they've said they're going to address this issue, but it's going to take years from now to for that issue to get solved. So right now they're actually in a sweet spot. It's similar to the way Snap is allow Snapchat actually why they're a relative outperformer in this space versus someone like Facebook. And they're obviously growing their partners in the U.S. as well as in other international markets. I'd prefer if it was more in the U.S., but it is more of their business in Asia rather than Europe, which is again another advantage to them. The big thing that they have is this, they call these single tap devices. So basically when you open new phones, installing these apps, or they're often already installed with a single tap. So if you think about when you're going through apps and putting them on your phone, they're basically installed almost instantaneously. So that's obviously for the user, it's something that we don't really think about, but it's almost a trick to get more advertising directly to you without you realizing what's going on. What the metric that I think is really interesting, especially with a name company like this, is they call it the RPD, or the revenue per device. It's improved slightly improved over every year, and especially in this last quarter. So clearly, this is something. If you look, their sales are growing, their margins are increasing. So another sector of the business I want to talk about is this single tap app installation business. So in this business, they're trying to grow to $1 billion of revenue. And this was a acquisition. And in terms of this part of the business, if you look at their last earnings report, the president of this division said that they wanted to grow this business to having 150 advertisers on this portion of the business in the next 12 to 18 months. So what's interesting is if you do the math and you look at what they actually said, in their most recent quarter, they added 35 of those. So now with that, they're up to 50 advertisers. And like I said, they want to go to 150 advertisers total. So if you backtrack it, even though this was a good quarter, if you look at their last few quarters, they've been averaging 17 advertisers per month. So with 60 months to go, for them to get to the 150 advertisers, they only need to add 7 advertisers per month, which is well below, like I said, the 17 that they've been doing and the 35 in the last quarter, in the last month. So clearly they're way ahead of that schedule. And I think the market's somewhat underpricing that. Looking a little bit at their financials, their ODM revenue grew 51% year over year, which is mostly driven by that single tap. And that revenue in that business was 800% year over year. So the only issue with that is the gross profit dropped slightly because of, some of the mix of the products and advertisers. But I fully expect this margin expansion to continue year over year. And to me, that's not an issue going forward. So basically, this company is basically firing on all cylinders. They did a couple other acquisitions with something called Ad Colony and Fiber, and these acquisitions allow them to penetrate advertisers like Procter and Gamble and Disney. And that one actually that's allowed them to expand their business on the iOS system because Android was originally their focus. And again, there's so many businesses and there's so many ways this company's firing on all cylinders. And I really think that this is a company that's been unfairly punished in a market where we're basically not rewarding stock selection yet. And I think that with their improved margins, their revenue increasing, all of the above, once the market kind of settles down, hopefully in the next couple months, and we go back to fundamentals and we look at, in particular, different companies within sectors, this one stands out as one that's a clear has tailwinds behind it. So in terms of structuring, like I said, the company is down 25% in the last 5 trading sessions alone, and the stock was trading around $90 earlier this year. So what I'm looking at is 2 structures. The most basic structure is if you want to look out to June, the 35-60 call spread, you can pay $5.90 here. And if it gets to $60, which it could, especially if the market settles down here and if you see some rebound in the tech sector, if you paid $5.90, you could, and it gets up to 60 or higher. It's about a 3.2 to 1 risk reward ratio, which is pretty good. And again, stock was trading near those levels within the last month. So could we see a reversal in that? Sure. And again, if it doesn't, you should have short growth names here that probably pair off against that. And if that happened, you would just lose $590 per call spread that you paid. So I think that's a pretty good risk reward versus the rest of your portfolio. But the other structure that I really do like is, and this is something that I put on myself in a ratio, it's a calendar call spread, buying the June 35 calls for $7.20 and selling the April 45 calls for $1.40 in a ratio. So, but on a one-up basis, you're actually paying $5.80 per spread. And let's say that the market rallies a lot in the next month by April expiration, which probably is difficult given all the uncertainty. Because remember, the market hates uncertainty more than it hates bad news. But should that happen, you would still be profitable. And in this case, especially on a 2-to-1 ratio, you would certainly make way more money on your June call than on your short April. But again, either one of those structures probably works well, and especially to play a market rebound, probably out 3 months. Because remember, 3 months also from here to June, you will get the next earnings report, which should come in sometime in early to mid-May.
Yeah, that sounds like a really interesting one, especially coming out of an environment, where volatility settles a bit. Should be a good one to watch. Anthony, let's go back to you. Do you have any sort of further thoughts on whether it's sort of markets or any more stocks?
Yeah, just a couple of sort of market charts, snippet type things that I'm sort of thinking about a little bit. And one of them is, you can see it here, is the percentage of positive and negative guidance that's come out of these results. And the information technology sector actually sort of 58% negative. So Raj, digital apps having upgrades to their guidance is sort of in the minority, and being, as you said, being profitable is in the minority. So sort of all bodes quite well. But you can see here, some sectors having no positive guidance, the majority having negative guidance. And what that tells me is we're still seeing earnings numbers and forecasts that are still substantially too high across the board. So I'd expect to see the same thing happening through this next quarter, seeing some downgrades coming through. So I'm going to continue to look for stocks on the short side that are going to see earnings downgrades. Obviously, we can't avoid what's going on in Ukraine, and putting aside the tragedy that it is, if we look at what's happened with geopolitical events in the past, and this table here sort of lists everything from sort of Pearl Harbor through to more recent events, drone strikes, Boston Marathon bombing, anything major, and you can see the impact usually is pretty minor. In addition, the impact usually takes not very long to recover from. So obviously, huge energy focus in this geopolitical event. If it doesn't escalate to involve the broader Europe, then it's not likely to have any more impact than it already has. And then the third table, just to highlight the boom-bust nature of what we've seen during COVID. So 2020 returns, some spectacular high growth returns, and it was very much just buy the dip and away you went. Well, many of these names, as you can see here, have had huge declines subsequently, giving up all those gains in some cases, many more in other cases as well. And just the math on those declines, when you see a decline of 50%, you're needing a stock to recover by 100% just to get back to where it was. So the whole buy and hold views looked pretty good. And why not lever it up during 2020? Well, it's all sort of come unstuck. And this table here sort of highlights probably 25, 40 names maybe that have really come back. So I'm focusing my short ideas, sort of continue to do well in this market. The long ideas that we've just spoken about, that's the type of things I'm thinking about. I'm glad Raj is looking at apps, Digital Turbine. It's a company I've looked at it before as well, and I think he's well and truly on the money.
Yeah. And like you said, you can find a lot of unprofitable companies here that you probably don't want to. That's not where you want to dip your toe in the water. I think again, I'd rather have something that makes money than not makes money. And that goes for traders as well.
Sure. Okay, gents. Well, we've come to the end of the show. It's been a great episode. I thank you again for both taking the time to come on. There's been a plethora of insightful information, as usual, from you guys, and I've benefited as well as our viewers, I'm sure. So look forward to catching up with you guys again in the near future. Now, as for all of you watching, remember to check out our website, itpm.com, where we've got a whole bunch more of educational resources that you can take advantage of. Particularly, I'm thinking about upcoming sort of seminars and webinars for you guys. I know that Anthony is actually hosting one on Saturday, a webinar, which is on trade idea generation, I believe, with Anton Creel, our managing partner. That's going to be a really good one. The week after that, we've got Edward Sheck. He's talking about how to structure trade ideas with options, particularly using calendar spreads. So a little bit more detailed in that one, and that's mainly for our alumni students. And then beyond that, we've got our War Room event, which I've talked about as well in previous episodes of What's on Your Mind. And that's just a really, really great event for you guys to learn from. As a quick reminder, that event will basically cover all sorts of things. It will teach you about trade idea generation, timing, key performance indicators, portfolio construction, risk management, all this sort of stuff, trade structuring as well. And all the guys that you see on What's on Your Mind will be sharing their knowledge throughout that sort of 10-day event. And as well as that, you also get some practical takeaways with how to build portfolios, because that is an exercise that we do within those 10 days. We take students' ideas and we build a sort of portfolio live for everyone kind of on the calls in the event, which obviously is centered around the current market environment as well. So really practical and lots of theory and interesting stuff to take away from that. I highly recommend it. Anyway, as I said, you can find out more information about all of that stuff on our website, itpm.com. For now, though, we've come to the end of the show. I hope you guys enjoyed the episode, and make sure you catch us again in a couple of weeks' time with another episode of What's on Your Mind.